we're talking today about investment banks and money managers. These are the people who manage investments. Investing used to be more of an individual thing. It still is for some people, but more increasingly there's an intermediary between you and your investment. Well, of course, I'm talking not about commercial banks or regular banks, but investment banks and other kinds of intermediaries like mutual fund managers, ETFs, exchange-traded fund managers, etc. So this is the reality of the modern world, and I thought we need to talk about it for this course. So we'll start with investment banks. So what do investment banks do? They traditionally do not accept deposits. They're not members of the Federal Reserve System. There's no FDIC insuring them. Well, they don't even have deposits. But what they do instead of, and so commercial banks take deposits and make loans. Investment banks don't take deposits and don't make loans, but in fact they underwrite securities. What does it mean to underwrite a security? It means you're the guy that companies go to, or nonprofits, or even governments go to, when they want to raise money, and they do it with you as like a broker intervening. To underwrite a security means to manage the process of issuing new shares in companies or issuing debt for companies or, as I said, for other organizations. Now, just to give some names, the term bulge bracket, I looked it up on Ngrams. It only goes back to the 1980s, so it's not huge old. But the bulge bracket firms are the big firms. First Boston, but they're gone. They're mostly not pure investment banks anymore. So First Boston, actually it was an outgrowth of the National, I think it's called the National Bank of Boston, but it became a investment bank in New York, big time. But it was acquired by a Swiss bank, Credit Suisse. Goldman Sachs was, until the financial crisis of 2008, was a investment bank. It was forced by regulation to become a bank holding company. And so now they're regulated as a bank, and they might as well accept deposits. So they are. In fact, there was news last year that Goldman Sachs had bought $16 billion of deposits from General Electric, the financial arm of General Electric. So they are now a bank. You can deposit money in Goldman Sachs. I don't know if it's up and running yet, but they don't have corner offices, or ATM machines. So they're not really in, what you think of as a commercial bank. But they're not a pure investment bank either. So they have an investment banking division.
Can I ask a question?
Yes.
Professor, you discussed a lot about how the business of investment banking are heavily based on people's trust, and I used to be an investment banker. I totally echo that. I'm just wondering about your opinion on how about the current stature of the investment banks, after the financial crisis, and how do you think they can improve their public image?
Well, I think investment bankers have a better public image than undertakers. Every occupation has its public attitude. So actually, I don't think people are overall extremely negative. Movies about investment bankers are usually very negative, right? They're usually criminals, practically. But if you have one living next door, you probably don't, because he lives in the rich neighborhood. So but if you did, you'd probably think he's an okay guy. He or she is an okay person. So I think there's something about, the way I view it is that finance is an important technology. Many people don't view it this way. It's not about shifting papers around and making obscure deals that exclude someone else. It's about making things happen. So any good activity has to be financed. And when you get people together to do something important, they start worrying. They have risks that they're concerned about, and they're wondering, is this for me or not? Or maybe I'm out of here. Maybe they'll do a cynical job as an employee. So you have to incentivize people. You have to protect them from risks. And that's, We are living in an age of financial capitalism. Now, it may create inequality and problems like that, but it also creates the tremendous growth, economic growth that we've been seeing around the world since in the last half century, particularly when there was greater appreciation of finance. So I think that there is mistrust and hostility sometimes, but especially after the financial crisis recently. But I think it's manageable. One shouldn't not go into finance. I think maybe politicians are lower esteemed than finance people. And that's also an important thing for people to do, and you shouldn't stay away from that one either. So what is underwriting of securities? It's issuance of shares and corporate debt. I might add, it's also, they're kind of like a consulting firm. A consulting firm is a firm that a company will go to for advice. They have researchers there. But the difference, an investment bank you go to for advice too, but an investment bank is like a consulting firm with an army. And I shouldn't say army, with resources. They know where the money is, and they can get it for you. And so they'll give you advice. It may share some of the risks of the offering. But the really important thing that investment banks do is put their reputation behind the issue. They check you out, due diligence. You're a company, you want to issue new shares because you need money. They have to figure out, why do you need money? Is this legit or is some scheme here? And then they will certify the issue. So the issuer is behind the. This deals with a moral hazard problem. Company, you could kind of take over an existing company, rise in the ranks of the company, and then raise money through issuing debt or securities. You look kind of sleazy, but the investors out there may not know that. And then you just kind of steal the money. You tunnel it out to yourself. So investment bankers are like bankers, but the public doesn't want to be the loser who makes some bad investment. So bankers are members of commercial bankers, which make loans, are members of a community, and they follow what's going on, and they look at the moral integrity of organizations, and they won't deal with sleazy ones. The same thing is true for investment bankers. So this is the moral hazard, as I was just saying. It's one kind of crime that, you may call it a crime, that managers of companies do is when they see that their earnings are unusually high, and they think, well, it's not going to last. we're going to drop in value. They have an incentive to issue shares when the public, looking at those earnings, thinks they're worth a lot more than they really are. So the public is necessarily skeptical about new share issues. Especially after a burst of earnings, they wonder if it's real or fake. The problem can be solved by borrowing instead of issuing to the public. Then when you're borrowing from a local branch of a big bank, the people at the branch really know business in your community, and they're not going to be fooled as easily. But it's also with it's also the same with investment banks. Studies have shown that investment banks that misprice issues suffer a market share loss afterwards. People, if they price them too low, in other words, the company says, I want to issue new shares, and the investment bank says, I think we should issue them at such a price, and it's too low, then the company is not happy. They didn't get enough for their shares. If it's too high, then the investors are not happy. So they have to find the right price, and that's how there's two basic kinds of offerings that investment banks do. A bought deal is so imagine you're issuing shares of a company. You are a company, and you don't know what to do. You go to an investment bank. The investment bank says, we'll buy those shares from you, but we're only a short-term investor. We'll flip them almost immediately. But we just want you to know that we can get this price for you. And then the investment bank hopes to make a profit on reselling the shares. Another kind of deal is called best efforts, and that's a case where the underwriter says, I'll try to sell your shares at such a price, and if it's not sold, then we'll just try again. It's over. We tried, we couldn't sell them at that price. So it starts out, the process is defined by law and tradition. There's a pre-filing period when imagine that you are a company needing to raise money. You first approach an investment bank, and then there's a called pre-filing period when you get advice from the investment bank about choices. Then suppose you decide to go ahead, the underwriter forms a syndicate. It's an agreement among underwriters. Typically, if it's a big offering, it's more than one underwriter can handle. So they go to their competitors, there are other companies that also do underwriting, and they form a syndicate to issue your shares. And they designate a manager of the offering. The reason they do that is that it's all about trust and connections. The reason you don't just issue your own shares is because nobody trusts you and nobody knows you, and you could be anybody. So you need contacts. So the investment bankers are among the most decorous of people and impressive of people. If you want a job as an investment banker, it helps if you are impressive and ethically, if you have a look about you that looks ethical and sincere. Investment bankers like to go to the symphony to be seen as among the upper crust people, because that's their business. They have to sell these things, so they have to look right. And they have to have their connections that they maintain. So one underwriter can't handle a big issue. They've got to farm it out to all the salespeople. You can call them salespeople. Then they file a registration statement with the Securities and Exchange Commission. And then there's a so-called cooling off period before the issue, in which they distribute what's called a preliminary prospectus, which describes the offering. On the Wall Street, it's nicknamed the red herring, meaning, well, I don't know why it got that meaning, but it's just a document that tells about all the risks that an investor will take by buying this security. And that document is regulated by the SEC, so it has to be forthcoming about risks. Now, most people never read the prospectus who buy into the issue. I did a survey once about that and found that, indeed, they don't. That's because they trust that their broker read the prospectus, and they trust their broker. Everything is built on trust. Not many people read these things. Maybe it would be a good idea to read it sometime. You can have that experience someday. So then the underwriting process, it takes the place. The members of the syndicate call their connections among investors and ask them, what do you think would this interest you? We think they'll say that we think it's a solid investment at some price, but we're trying to find what the price is. And then at that point, they do due diligence. There's a due diligence meeting between underwriter and the issuing corporation. They decide on an offering price. They write an underwriting agreement. They'll say how the underwriting is split up among members of the syndicate.
An underwriting syndicate is a band of investment banks and broker-dealers who come together to sell new offerings of equity or debt securities of a firm to investors when the issue is too large for a single firm to handle. The syndicate takes on inventory risk by committing to purchase the full issue up front and selling it afterwards to investors in the market. It is compensated by the underwriting spread, which is the difference between the price paid to the issuer and the price received from investors.
They have a dealer agreement. Dealers purchase from underwriters at a discount. There's an effective date when it goes on the market. And then after the whole thing is done, when they've sold the issue, let's say it's new shares, the underwriter typically supports the price in the so-called aftermarket. The issuing market is the price initially. Everyone gets the same price in the initial offering. After that, then it's open to the market, supply and demand. But then they typically support the price. That means suppose the price starts dropping days after the issue. the underwriter thinks that's a reputation concern, because if people bought into it and they lose 20% of their money in 3 days, they get annoyed and they start thinking badly of the underwriter. So the underwriter will typically go in and buy to support the price of the underwriting. That's called stabilization. Now, some people thought it was unethical for an underwriter to do that, because the stabilization seems like a market manipulation. They're not doing it because they want to buy it. They're doing it to prevent a panic or anger. But the SEC has decided that this stabilization is a good thing. And so they're legally allowed to conspire to fix prices in market at least until the entire issue is sold out. I think maybe it is a good thing. You want stable markets. And if the underwriter is willing to buy it, they're taking a risk. Anyway, we need somehow to supply capital to business. And the fundamental problem is that nobody in the real world, most people don't know the business. They can't figure out whether they're being tricked or not. So this kind of fixing looks okay to the SEC, and so it's done widely. I found a 1929 textbook on investment banking, and it says, the seller desires to have conditions so shaped that the price of the issue will remain stable. Or even better, it will rise slightly. That'll be good news. So in fact, there's some tendency to underprice the new issue so that its price rises in the immediate aftermarket. If you just bought 10,000 shares of some company, or it might even be a new company, you watch the news every day for a few days afterwards. You're really attentive for a while. So there's a tendency for underwriters to underprice them a little bit in the market to establish a favorable psychological attitude of investors. The term manipulated market is not altogether a misnomer. An initial public offering is an offering of shares in a company for the first time publicly. They could have privately placed shares. A small company, like I had a company, Shiller Weiss Incorporated, formed with my student here at Yale, Alan Weiss, and we were private. We didn't issue shares very often, and we were not listed. You won't find anything about us on stock exchanges. And then we sold the whole company. That was in 2002. So there were never any shares, public shares. Public shares are shares that are regulated for the general public. It's very clear the SEC does not judge the investment potential of companies. They don't get into deciding, is Facebook going to succeed or not? That's not their business. They only are deciding that it's not manipulative and distortion driven. So an IPO is an initial public offering. It's been documented that the price in the aftermarket tends to be higher than the offering price in an IPO. This is a well-known fact. It jumps immediately. And again, the issuer then might complain to the underwriter. The issuer then says, hey, you priced our issue at $25 a share, and the next day it was $30 a share. So why didn't you ask $30 a share? We would have gotten $5 more. And I can tell you what the underwriter will say. The underwriter will say, we do this all the time. He might not be so blunt about it. It's a trick. It gets people positive about our company. If you don't like this, go to some other underwriter. But I'll tell you, the other underwriter won't be as successful. He'll only get $20 a share for you because he doesn't have the goodwill of the public. So it's a sort of manipulation, deliberate. They underprice the offering from what they know they could get. That way it sells out quickly, it looks great. In fact, it's also a problem with IPOs is that you can't get into them as a purchaser. You try, you call up as a Yale undergraduate, a broker, and say, I'd like to, I have a little money, a few $1,000s my parents gave me. I'd like to invest in an IPO. And your broker will say, come back in 10 years. We'll talk later. It won't do it. Why won't they? Well, because they underprice them, and they want to give that to their favorite customers. So This all sounds like a manipulation. Well, it is sort of, you know, in my book with Akerlof, Fishing for Fools, we describe the real world as filled with manipulation. Everyone's trying to trick you. But we don't make it that evil. It's usually okay. And what IPO underwriters are doing is sort of okay. So you as an issuer of new shares are consoled by the fact that even though you didn't get that extra $5 for your share, you got $25, which is pretty good. And that's just the way the world works. So they leave the money on. Now the other thing is this manipulation is in some sense too successful, because in the long run, IPO prices tend to fall. Jay Ritter, who's a professor at University of Florida, wrote a famous article in 1991, said that at least as of 1991, the average IPO jumped 16% on the first day in the aftermarket. So they're really underpricing. But then if you wait a while, wait a couple of years and it's gone. So they tend to fall. This is a secret that the IPO broker won't tell you about. That's why you can't get into an IPO. So you are a hotshot young student and you call a broker and say, I'd like in on this IPO. The broker is thinking, you know, this guy's just going to flip it. I don't want customers like this. You know you'll make 16% on the first day. But I'm not going to sell to you. I'm going to sell to some elderly couple who are not paying attention. They won't sell the next day. I know who I'm selling to. I don't want them to sell the next day because I might have to support it in the aftermarket. So you say, no to you, hotshot young guy. We're going to sell it to stable investors. It's all kind of manipulated like that. And then, you know, they'll notice that it went up the first day, and they'll call me and say, it's looking good, isn't it? Then they'll just completely forget about it. And then they'll lose the money eventually. But you know, it's not all that bad. We'll put them into a decent investment, and eventually it'll go up. But maybe not for 3 years. But hey, I know my clients. You have to hope these people have some ethics, and I think they do have some ethics. It's just the real world, right? There's a lot of tricks played. So I called this in some paper about the impresario hypothesis. I make it, what underwriters do is analogous what concert impresarios do. So suppose you are managing an artist, a singer, or an orchestra. What do you do? Have you ever thought about how you would do this? Well, what you want to do is create talk about your client, right? You want sold-out sold-out audiences, and you want newspaper stories saying people were standing in line all night to get into this such and such concert. And then that impresses the public. And then you fill up concert halls because the news spreads and people think this is hot. Well, but immediately you might ask, well, why don't you just raise the price on the concert? And then you make more money. But you see, that would be short-sighted. An impresario knows better. Keep the price low. And you want these hungry-looking young people coming to the concert and standing in line. You want that. And the only way you get that is if you underprice it, because they can't afford. If you charge the maximum you could charge you wouldn't fill up the auditorium. The profit maximizing in the short run. You wouldn't fill up the auditorium, and you'd get all these old people or comfortable-looking wealthy businessmen that would just destroy the whole atmosphere of the concert. So you've got to keep those young people, the excited people, in. Impresarios are known for this, right? They do stunts, they do publicity stunts, and they also don't charge the highest price. That's why we have the price pop in IPOs at the beginning. Now, Charles Ellis is he was a member of the Yale Corporation on the board of directors and connected to this university, but never a professor here. He wrote a book called The Partnership just before the financial crisis about Goldman Sachs. Goldman Sachs was maybe the most esteemed investment bank in the United States at that time, very successful. So he wrote a book which was admiring of Goldman Sachs, though at times maybe it sounded a little critical. So what was behind Goldman Sachs? Number one, making money, always and no exceptions. There's a different culture at Goldman Sachs than there is at the university. And if you ever go there, you'll see it rather starkly. Nothing was ever done for prestige. Although indirectly, of course, they want prestige because that helps their business. But it's always money, money first. The most prestigious clients were often charged the most. And then there was a sense of loyalty, absolute loyalty to the firm and to the partnership, and personal anonymity. Right? You don't go around flaunting your name. You flaunt Goldman Sachs. All right? This is the Goldman Sachs culture. It worked. This kind of thing works. So a unique blend of a drive for making money and the characteristics of a family in ways that the Chinese, Arabs, and old Europeans would well understand. John Whitehead then long ago became chairman of Goldman Sachs. And he issued in the 1970s principles that sounded a little bit more idealistic. I think companies have to assert principles, and leaders of companies have to do that. John Whitehead's principles, I think, were contrary a little bit to what I just said, the old Goldman Sachs. Whitehead wanted them to be a moral company. But again, they're still interested in making money. So he said, actually, the first objective is not money for Goldman Sachs. It's money for our client. We're all about money, but it's about money for the clients first. Second, our assets are people, capital, and reputation. I'm doing typos here, sorry. That's reputation. I was saying that the whole business of investment banking is about people. It's about trust, about building reputation. That's the asset. Uncompromising determination to achieve excellence. Now, this may sound a little bit like manipulation in itself, but I think it's serious. We stress creativity and imagination. He lived, 93 years? He was chairman of Goldman for 38 years. More of his guidelines. Talk to the boss. Okay, when you're now a young person at Goldman Sachs. It's your first job, all right? You call up some big company. Who do you talk to? You demand to talk to the, not the assistant treasurer, but the CEO or someone very high up. How did you get the nerve to ask to do that? Well, Whitehead wants it to be very clear. You are at Goldman Sachs. You talk to the CEO, okay? There's something about ego that is profitable in business, and he wants gold. You have to live up to that. You know, you don't talk to the assistant treasurer. You never learn anything when you're talking. He wants you to be a good listener. And then you have to respect individuals' worth. And there's nothing more worse than an unhappy client. I think there is some substance to these, but to these points that Whitehead is making. The new Goldman Sachs was drifting away from these, some of these, notably the putting the client first. And you know, there was just a settlement in the news the other day about Goldman had to pay $5 billion for dishonest marketing of mortgage securities. So, you know, they've slipped a little bit. Well, Whitehead died. You know, I think that the leadership involves personal force, and Whitehead eventually, he lived a long time, but he eventually died. Also, they lost their partnership structure, which gave it less of a sense of family, and they lost some of their principles, but not altogether, I think. There's still a lot of good people at Goldman Sachs. Now, I want to talk about rating agencies. As an alternative to trusting an investment banker, you can trust a rating agency. And so what is a rating agency? It's an agency that publishes its information instead of keeping it secret for their favored clients. So the first beginnings of a rating agency were by a book written by Henry Varnum Poor, published in 1860, called History of Railways and Canals in the United States. But it was more than a history. It wasn't a history book for history buffs. It was focused on companies and what their situation was. So it was the beginning. That letter later led to Standard & Poor's Corporation. Well, Poor's in 1916 merged with Standard Statistics to form Standard & Poor's, long after Henry Varnum Poor. But John L. Moody founded the first true rating agency called Moody's Investor Services in 1909. And he decided to give letter grades like in college. Now, already colleges were doing this grading system, A, B, C, D grading system. So he thought people would understand that. He's going to grade companies for their integrity and ability to come through for you. And the best rating he gave was not A+, it was AAA, AAA. And then there was B's, C's, D's, and bad ratings as well. In his 1933 book, The Long Road Home, Moody, I think maybe I said something about this, described his moral mission. He said, I always, like any other young person, wanted to become a millionaire someday. But he said, you know, I had other impulses as well. And one of my impulses was to tell the truth and tell everybody. I don't feel like someone who should keep secrets. I wanted to publish it and get it out there. And those bastards who are playing tricks, they'll be exposed everywhere. So he sold books, Moody's Investor Manuals, describing every major company and what he thought of them. He loved to do it because he likes to criticize, I guess, or likes to do that thing. And it was a huge success, and it remains so today. Originally, they would not accept money from the people they rated. That broke down. Moody's said that as a principle. You read it. Well, it's just like, could I, as a professor, accept cash from you for, that you would hand me money, and then that might be a bribe to raise your grade? Of course, that's obviously unethical. But rating agencies, it should be the same for rating agencies, right? But that broke down in the 1970s when rating agencies found it difficult to keep up with all of the complicated securities that were being issued. And they started charging for it got really crazy with the mortgage securities that took so many different forms and they're so complicated. So rating agencies said they had to charge for it. And then it turned out to be a great business. Rating agencies, which were never big profit centers, started getting involved in all the complicated new derivatives finance. And we're making a lot of money. So it was hard to... So those of us of you who came with me to see The Big Short will remember the scene when Steve Carell, the actor, goes into a rating agency and talks to a woman and then asks her, who's a manager of a department there, and asks her, what do you know about the underlying mortgages behind this security? And she admits nothing. And then he said, well, why do you give it a rating? And then she said, well, if we don't, our competitors will. So that was an outrageous thing to say. You saw it in the movie. Whether it actually happened, I don't know. I wasn't there at that meeting. But I heard things like that in the early 2000s, that the rating agencies were getting casual. So the rating agencies have improved their act substantially because of new regulations and their loss of reputation. So there's now more care in... they still accept money because their business kind of... they still accept money for ratings because their business kind of requires that now. The Glass-Steagall Act was one of the most famous acts of Congress in 1933. It did a number of things. Notably, it created the Federal Deposit Insurance Corporation, which was the first insurance of commercial bank deposits in the United States. So the idea of an investment bank was really created, of a separate investment bank, was created by Glass-Steagall. So the problem was that people thought that the crash of 1929 had something to do with banks and investment banking and commercial banking being in one operation. And rip-off, there were rip-offs. So if a bank was both an investment bank and also a commercial bank, then the investment bank could use the knowledge from the commercial bank to do insider trading of securities which somehow was connected back then to the 1929 stock market crash. So the really important thing that's most remembered about the Glass-Steagall Act is it said that you can't be both an investment bank and a commercial bank. So that's why we have Morgan Stanley. Now, it's changed since then, but why is Morgan Stanley separated from J.P. Morgan? Also, why First Boston Corporation separated from the Boston National Bank, I think it was called, in 1934. It was because of the Glass-Steagall Act. But that was repealed. Oh, by the way, other countries didn't do this. So the United States had a complete separation of commercial banking and investment banking. But other countries allowed what we call universal banking throughout this whole period. Over the years, these investment banks and commercial banks complained that they couldn't compete with European, or they're having trouble competing because they couldn't offer all the services that were seamlessly offered by European banks. And so because of lobbying by banks, regulators nibbled away at Glass-Steagall and were beginning to allow commercial banks to get involved in certain investment banking operations. And then the Gramm-Leach Act of 1999, which was signed by President Clinton, finally ended Glass-Steagall. So they can now do both. You can be both a commercial bank and an investment bank. And that led to a wave of mergers of commercial banks and investment banks and insurance companies, which had also been kept separate. So there's some Travelers Group and Citicorp merged. Chase Manhattan Bank acquired J.P. Morgan, so it's now called J.P. Morgan Chase. And UBS Switzerland bought Paine Webber. Credit Suisse bought Donaldson, Lufkin, and Genrep. That's all after. But now there are still people who want Glass-Steagall back. One of them is Paul Volcker, a former Fed chairman, who was actually one of the most famous Fed chairman of all because he really whipped inflation. There was out of control inflation. And when he became Fed chairman in 1979, he created a recession, actually a worldwide recession. And he lobbied, among other central bankers, we can't just keep feeding inflation, and it's going to have some cost. So it cost the so-called Great Recession, among the recessions so-called, well, there were two of them, 1980 and 1981-82, which was a severe recession. But he seemed to break rising inflation. So he wanted to put Glass-Steagall back with the Dodd-Frank Act, and he instead managed only to put in something called the Volcker Rule. The Volcker Rule is that commercial banks cannot do proprietary trading. They can do investment banking, but they cannot directly own hedge funds or other risky investments. So commercial banks are allowed to underwrite securities and do the normal activities associated with underwriting of securities, but they can't be just buying for their own account risky assets. The other part of this lecture is about professional money managers. Now this is different from investment banker or commercial banker. We're talking about people who invest other people's money by taking over the management of their portfolio. So they deal with a public. Now you could say a commercial bank is like a money manager because it's taking your money as a deposit and it's investing it in something, loans or mortgages. But we're talking more about, now we're talking about people who take your money in a different way and invest it in stocks and bonds or other normal investable assets in the open market. Not necessarily public, they could be private. So I wanted to just first look at what it is that Americans hold. America is probably typical of advanced countries today. So this is the total assets of U.S. households. Now, unfortunately, the Federal Reserve that computes these statistics puts nonprofits in with households. That's because they're like households. They're not owned by anybody, so what do you make of them? So, but almost all of this is households. So it just tells you where the money is. So the total is 101, this is in billions, so this is $101 trillion. So that's the total assets of Americans. If you divide that by the population, I think that's about, that's on the next slide actually, it's about 270,000 per person. So this is a rich country, I think you'd say, if the average person owns $270,000. Another way of putting it is, take a traditional family of 4, okay, that's 4 persons. The traditional family of 4, mom, dad, 2 kids, is now a minority of the US population, but they're still there. So, but let's take that traditional family. That says they have over $1 million. So the typical, if you do it this way, calculation, you divide 101 trillion by 320 million and multiply by 4, you get $1 million. So the typical household is a millionaire. $1 million isn't what it used to be. On the other hand, we're living pretty well. But I have to qualify that. You remember, we have great income inequality in the United States. So that's the average household. The median household would be much lower than that. And the bottom 10 percentile would have assets of just about 0. But anyway, let's look at this average and where it is. So the Federal Reserve in table B101 computes totals of assets held. So you just get an idea what people own. So about a quarter of that $100 trillion is real estate. People own homes. This is the value of the homes. It's not subtracting the mortgage yet because people owe money, but we're just looking at the assets now on a balance sheet. So that's the biggest single thing, I guess, homes. People own their homes. They also own interest in pension funds. This is a big business. It's almost as big as your house. That is, when you take your first job, they will probably tell you that we will be contributing to a pension fund for you, or promising to pay you. We're going to talk about pension funds in a minute. That amounts to about $20 trillion. Now, equity in non-corporate business, that's an estimate. Lots of people have businesses, and they're not corporate, they're not traded on any stock exchange, but they've tried to value them, and they assume these businesses together are worth about over 10 trillion. And then stock. Now, these are stocks owned directly by the public. It's 13 trillion. It's about half of what they own in household. Now, again, this would be very limited among the bottom half of the population. There's it's wealthy people typically who own stocks, or dilettante, people who like it, who are interested in investing. Deposits are about the same, but they're distributed to lower income people more. Bank deposit, that's about 10 trillion. Mutual funds are coming back to that, is an indirect ownership of stocks and bonds. That's 8 trillion. Consumer durables, this is your car, your living room furniture, I don't know what else. Everything you own, durable item that you own, that we don't normally value, but they've put a value on it. It's about 5 trillion. Government bonds, treasury securities, not so much. People don't generally, most people, your grandmother may have given you a saving bond as a Christmas present, but it's not worth much, right? The public is just not into buying them directly, but they're bought indirectly. It's in their pension funds and mutual funds. Most people just don't get into buying government bonds. Even corporate bonds are even small. Look at that. It's only 296 billion. So the typical household is not owning corporate issued bonds. They're a little bit higher on municipal bonds. They'll own them directly. Municipal bonds are bonds issued by local governments, and they have the advantages that they're tax-free. So wealthy people, particularly who are in high tax brackets, like these, and they will own them directly. Life insurance is another $1 trillion. People have life insurance policies with cash values. And I didn't fill that in, but that's what people own. So anyway, today when we're talking about pension funds mutual funds, what else? Pension funds and mutual funds. We're talking about something like close to $30 trillion, which is managed by institutional investors. So, I have to talk about liabilities. Those were the assets, but they also owe money. So this is again from the Federal Reserve, the same table. Home mortgages, almost $10 trillion. So that is it. You have a, what did we say, 25 trillion for real estate minus 10 trillion. So it's about 15 trillion in net worth invested in houses. Now, consumer credit is another liability. These are things that you owe. You owe on the mortgage and you owe on your credit card. Or it could also be another form of consumer credit, like when you buy furniture from a store, they would give it you on installment. That's only $3.5 trillion. Loans that people take out at banks, not so big, 1.5 trillion, not counting mortgages. Most loans are in the form of mortgages, but you can get a vacation loan or a college loan, as you may have heard, some of you. The total liabilities are 14.5 trillion. So the difference between assets and liabilities is 86 trillion. That won't bring us up to $1 million per household. I was doing it just assets and not considering the liabilities. The prudent man has been changed to the prudent person. But regulators have wondered, how can we define what good behavior is among investment managers? In 1974, ERISA, the Employment Retirees Income Security Act, defined a prudent man and required that investment managers behave like a prudent man, a prudent person. And that is quoting the act, with the care, skill, prudence, and diligence under the circumstances then prevailing, that a prudent man acting in like capacity and familiar with such matters would use in the conduct of an enterprise of a like character and with like aims. It's the strangest regulatory demand. What it's telling investment managers to do is do what somebody else would do in this circumstance. Well, that's maybe overstating it a little bit. But you don't have to do exactly what they're doing, but it has to be prudent. This prudent man rule has been a bugbear for investment managers ever since 1974. The Dodd-Frank Act doesn't ever use prudent person. We've updated it now. We can't say man. It has to be gender neutral. But beyond that, they've dropped person out completely, and they called it prudential standards. That appears 34 times in the Dodd-Frank Act. And we're moving away from the reliance on the prudent person rule into having more concrete regulatory standards. However, there's so many details. If you move away from the prudent person standard, what do you substitute? Now we have to be explicit, and the financial world is so complicated. A financial advisor is anyone who advises others on the value of securities or the advisability of investment, or who publishes analyses. It excludes bankers, lawyers, reporters, and professors. Okay? So I am not your investment advisor. I have to not claim that I am. We're only giving you general education and not tailored advice. Financial advisors listen to your situation and give advice that's tailored to your situation. It also excludes broker-dealers. So now we're trying to get past the prudent person. We have to regulate all of these people. We have to define their different categories. A broker-dealer is a company that you would go to buy and sell securities. And when you call your broker, you could just say, I want to place a limit order to buy this share at such and such a price. That would be a pure broker-dealer interaction. But typically people, when they call their broker, they'll also say, I'm thinking of buying these shares. What do you think? And so the regulators decided not to tell the broker-dealer that he can't answer that question. So he or she is a bit like an investment advisor, but it's excluded from the category. So financial advisors are then regulated. See, in the United States, the National Securities Markets Improvement Act of 1996 required that all advisors managing more than 30 million each must register with the SEC. Those managing less than 25 million have to register with their state securities regulator. You might wonder, what if I manage 27 million? If I'm in between 25 and 30? Well, then you have a discretion. You got to go to one or the other. The Act does not mention prudent person, but it does bar convicted felons from serving as an advisor. So we're trying to get good people. Now, a financial planner is someone different. That does comprehensive planning for life for you. It's not regulated. We have organizations like the Financial Planning Association, which certifies people as certified financial planner. The Dodd-Frank Act, even though it's 1,000 pages long, asked for only a study of financial planners. There's just too many details for the world is. How do we regulate them? That's a problem.
If you're looking for a financial advisor, what should you look for in the traits? If this is someone who you should be calling in the middle of the night when you're having a dispute or when you're wrestling with a financial challenge, in your household, how do you even qualify someone for taking on such a task?
Well, that's a good question. I think one thing is you have to talk to other people who have financial advice and get referrals, references from them. Because I think a lot of it is a sense that you have when dealing with someone, whether they're really have your interest at heart or not. There are also organizations that certify advisors, like National Association of Personal Financial Advisors. Not a perfect organization. They got into some financial scandal a couple of years ago. But I think that they're a good organization overall. And one can work through these means as well.
There's been a trend of more automated advisory services.
Right.
And you talk a lot about client relations and also just kind of the quirks of social behaviors. How do you see this trend evolving, and do you think that more computerized mechanisms could really replace that personal connection that financial advisors are able to curate?
See, now this gets back to the same question we were just talking about machines replacing jobs. Now you might think that financial advisor would be one of the last jobs that a machine would replace, but it is happening. And the machines, I guess an advisor always asks similar questions. What's your risk tolerance? What are your goals in life? How old are you? Things like that. Well, a machine can answer them and give stock answers as well. This is a big trend in our society, and it's replacing a lot of jobs. The question is financial advice high on the list of jobs that will be replaced? And I'm thinking it's actually relatively low on the list, in the sense that these programs will be helpful. But I think that at some point in making important decisions about your future life, you do want to have a real person. It's like the same question. Well, here we are on MOOC on Coursera. We're in a course that kind of replaces direct human contact with something recorded. But I think that still teachers will not decline in our society precisely because of a basic human trait that you don't want to be just listening to a machine. You want to have some kind of relation with your teacher. And I think it's the same with financial advisors. They can motivate you better. They're more, they're part of your world. And so I think that's probably where we're heading. So I'm thinking that financial advice is not going to be completely mechanized. But I think it's maybe a good idea to look at some of these websites to get some insights.
What do you think about some of the other things like robo-advisors? And she hinted at algorithmic trading and dark pools and shadow banking, things that are also financial tool-based.
Right.
Where do you think that that's taking the industry? In a good place or a not-so-great place?
Well, I think I'm all for progress, and automation seems to me involve some of those things. And the one problem with financial advice is that it's expensive. The kind of people who can give good advice are also well positioned to make money doing something else. So you have to pay them for it. To hire a financial advisor on a fee-only basis might cost you $300 an hour. And for lower income people, that sounds just impossible to pay for that. So another thing I've been advocating is government subsidy that operates at lower income levels for financial advice. The current tax deduction that's available for financial advice applies only to high income people who deduct or who have in the high tax brackets. But I'd like to see some payment for financial advice to lower income people. Now, we already have some of that through philanthropy. This is where philanthropists come in. We have legal advice clinics that don't charge for low income people. But if you talk to someone who works at a legal advice clinic, you will quickly find out that they're swamped and they can't go to bat for these people. A lot of the issues relate to marital problems, and the husband and wife are disputing something. You can't go to bat for one or the other. It's just, unless you can't pay for this. It's just not enough. So anyway, I think that government support of advice services or philanthropic support is something that would be helpful in the future. The Dodd-Frank Act in the United States created things that sounded like it, but they're not really funded to. We have like the Consumer Financial Products. Did I say it right?
The Consumer Financial Protection Bureau.
Protection Bureau.
CFPB,
Yeah. You can give complaints there and you can get help sometimes, but it's not the same as having your own lawyer representing your interest. But I think, so this is something that as computers replace normal human labor, one thing that I think that we'll end up with more people in the advice business. We'll have more psychotherapists too. We need more of my wife's a psychotherapist, but lots of people would benefit from having someone to talk to regularly about their problems.
Do you think, I mean, in your view, is financial advice needed for people that have below a certain amount of savings, or are they really just better off indexing? It seems like a lot of the data lately is there.
I think that the financial crisis hit people of low income particularly hard because they weren't getting elementary financial advice. They were hearing in the news that I should own a house, and then they would be encouraged to take out a mortgage for a home that they left it to the bank to decide if they could afford the house. The bank should have experience in knowing who might default. But the banks were selling mortgages off to, they didn't care. The investors were willing to buy these mortgages. There's a bit of a problem here. The rating agencies weren't really raising alarms, so something was amiss. I think that if one of these low-income, and often they were selling adjustable rate mortgages whose rate might go up. After all, it didn't go up because we have zero interest rates now, but it could have gone up, and so these people would be in trouble. I think that if they had gone to a financial advisor in, say, 2005, 2006, just before this crisis, some advisors wouldn't help them. It was a nebulous issue about whether you should buy a house. I'm sure some advisors would mess up. But I took a quick look at some advice books from around then that were published by Susie Orman and people like that. And I had the impression that they weren't gung-ho about taking out a big mortgage and buying a big house that you can barely afford. I think it would have been better if they had had advice about something simple like that. And it's not so much that they need portfolio management and picking stocks, but they need also, I think they need, it's almost like a therapist. they need someone to coach them to save a little bit and tell them that, you could lose your job or something could happen, and then where would you come up with money? And a lot of people have never thought about that. And they could tell you as an expert realistically, and not a Wall Street expert, a personal finance expert could tell you realistically. So, there are private charities that have done things like this. Notably in the United Kingdom, there's a big movement toward what are called citizens' advice bureaus, which are staffed for low-income people, or it could be anyone. They don't, but mostly customers are lower income, and you can ask about anything, because often people's questions blur into different areas. Should I buy a house? I might get a divorce. Our child might be handicapped. All sorts of issues. And so the Citizens Advice Bureau brings the right expertise that you need, and for free. We actually have a few of them in the U.S. It's not big here. Now, mutual funds, that was $8 trillion. So what is a mutual fund? Well, in your book, Money Changes Everything, Will Getzman claims that they date back to the 1770s. This is the name of a Dutch, of course it's the Dutch who invented everything in finance. Well, I'm exaggerating, but I like that. They had one, I can't pronounce that. That's the name of a mutual fund from the 1700s. There were many investment companies that developed over the centuries. Notably in the 1920s, there were many investment companies that offered to invest your money for you, but they weren't properly regulated. And a lot of them were playing tricks. Notably, they'd have different classes of shares, and the classes were designed in a tricky, deceptive way so that they, the owners of the Class A shares, had much better prospects than the general public that were in Class B shares. So after 1929, when a lot of these investment companies revealed their really bad performance, it led to public antagonism against investment funds. Now, the leader in the United States was the Massachusetts Investment Trust, called MIT. No connection with the Institute of Technology. It had a fund with only one class of investors. Moreover, it published the portfolio, so there was no secrets, and it redeemed on demand. That is, you could, if you invested in MIT, you could get your money back any day with just a phone call. Now they had telephones. Everyone had a phone. You could call MIT and say, I want my money out, and they would cash you out at value. In other words, what your share of the total MIT portfolio was. And after 1929, a lot of people looked on MIT as a model for investment management. So Investment Company Institute was set up, I think it's in the 1930s, and they began advocating for this kind of investment company. And in 1940, the Investment Company Act further clarified, although the word mutual fund doesn't appear in that act. So do you understand? Let me say, what is a mutual fund? They're very popular. What they do is a classic mutual fund, as defined by the SEC under regulation. If you want to buy into a mutual fund, you have to contact the mutual fund, or there are these supermarkets now that will allow you to put in. But you're not buying shares on an exchange. You contact the mutual fund and you say, I'd like to invest in this fund. You give them a check for, say, $10,000. Then you will come in as an equal at 4 p.m. on the day you do that. They only deal at the closing price. So then you now own a share of the overall portfolio for the mutual fund. The mutual fund subtracts expenses for managing the fund. They pay their salaries. But otherwise, you own what's in that portfolio, your share of what's in that portfolio. And when you decide to sell someday, you call them up again and say, I'd like it. Then at 4 p.m. on that day, they'll figure out what your share of the total portfolio is and give you that in cash. That's a mutual fund. Another kind of investment fund was not invented until the 1990s. It's called an exchange-traded fund, and it operates differently than a mutual fund. Now, these are all described in Fabozzi's chapter, which I assigned, which is a good background reading. Exchange-traded funds maybe they're more pitched at people who like to trade in and out. They don't like this 4 p.m. rule. ETFs are a kind of investment company investment fund that is more liquid and tends to have lower management or expense ratios. They were promoted as for smart investors who don't need the mutual fund structure. So here's how it works. The first ETF was for Standard & Poor 500 stock price index, and the first ETF was called a SPDR, SPDR. That's Standard & Poor Depository Receipts, and they were only going to invest in the S&P 500. You could actually buy the S&P 500 by buying an ETF. Okay, let me step back a minute. Mutual funds are called open-end funds because you can pull your money in and out. You're owning a share in a portfolio, and you can get it out at market value at 4 p.m. of every day. There's another kind of fund, which Fabozzi talks about, called a closed-end fund. A closed-end fund is different from a mutual fund in that you buy a share in the fund on a stock exchange. That closed-end fund then is a share that you can't go back to the fund and say, I want my money back. The fund invests the money and it pays dividends out, but it doesn't redeem. It has IPO. It issues shares and drops them on the market, but you can't go back to them and ask for it. Instead, you have to sell your shares. Now, the advantage to closed-end funds over mutual funds is that closed-end funds are trading continually all day long. So if the market is crashing in the morning, you don't have to wait until 4 p.m. to get your money out. If you want to do that, you just sell on the exchange immediately. But the disadvantage of a closed-end fund is that it doesn't track the value of the underlying assets necessarily because it has its own market. And sometimes they sell at premiums and sometimes they sell at discounts. Now, there's no tight process enforcing that the value of the fund is equal to the value of the investments because you can't get your money out. In other words, it's very hard to get your money out, and so it could be selling at a discount for years, and you're tough luck, you know. You say, why don't other investors know this? Well, maybe they don't trust the management, or something like that. The management of the closed-end fund is incompetent. So ETFs were developed as an alternative to closed-end funds and to mutual funds as an invention. It was at the American Stock Exchange in 1993. I met the guy who invented them. What was his name? I can't remember it at the moment, but it's not that old. He said, how can we make something like a closed-end fund that's traded on the exchange and make sure that it tracks the underlying value? And so he had the idea that we will create a fund that is not for the general public, but for arbitrageurs, is immediately redeemable. So if it's selling at a discount, we want to create a mechanism for, or at a premium, a mechanism that will restore the price. So the mechanism is that they have authorized participants. When you create an ETF, like the SPDRs, you identify a group of Wall Street firms that we will authorize as participants in this ETF market, as opposed to just shareholders in the ETF market. And the ETF authorized participants, are authorized to either create or redeem units in large amounts, say $1 million. That wouldn't appeal to retail investors, but we're putting that in there for a purpose so that the ETF doesn't sell at a premium or a discount. So if the ETF is selling at a discount, that means you can buy it for less than the asset value. The authorized participants can redeem there's a process for them to redeem the shares and get the underlying shares back. So they will do that if there's ever much of a discount. If they're selling at a premium, that is, people are paying more for the ETF than the stocks that it holds, they can create more ETFs. But again, in big units, let's say $1 million, it's in the contract for the ETF. So they do this. The reason we're making that happen is to keep the ETF price tracking the underlying price. So that's an ETF. Automatic creation and redemption. There's many ETFs now. I don't think it was shown separately on the Federal Reserve. I think it would be under stock. But a lot of people own stocks through ETFs now. But it's still not as big as mutual funds. They're typically for smart investors. They don't advertise. Well, they do advertise. Spider ads you'll see. But I don't think it says much. And they have a very low management fee, typically something like 12 basis points. Now I want to talk about exchanges, notably stock exchange and brokers, dealers, and clearing houses. So let's just go to some really basics. A broker. I have this, I've written down BOAC. The definition of a broker is someone who acts on behalf of others, that's the O, as an agent for which they earn a commission. So a stockbroker, what he or she does, is brings people together so that they are, if someone who wants to buy a stock, he finds someone who wants to sell that, puts the two together, charges a commission for finding the other side. That's a broker. A dealer is different. A dealer always acts for himself, or the H is a problem, or herself. They both start with H. A dealer always acts for herself. In other words, as a principal in the transaction for which she makes a markup. So that's a fundamental difference. So if you're buying from a dealer, the dealer owns some of the shares that you're buying, and the dealer sells it to you at a price. There's no commission, but the price is higher because you're buying. If you want to sell to the dealer will buy from you, and they'll buy from you at a lower price. The difference between the two prices is called the bid-ask spread. A broker-dealer is it could be an individual or a company. It's typically a company that potentially involves both brokers and dealers. So a dealer posts prices, bid and asked, and stands ready to buy. They may be required by the exchange to execute a small number, at least a small amount, at the posted price. But if you want to buy 1 million shares, the dealer is not expected to stay with the posted bid and asked. They're analogous to an antique dealer. If you go to an antique store, the dealer has bought the antiques, and there won't be any sales commission. They'll just sell you the product. Bid-ask spreads on antique dealers are much wider than stockbrokers. Why is that? Well, I think it's because they have more costs of dealing. Antiques are unique items, hard to sell. They have to put them on a showroom floor. They have to answer questions. So they have to make more money per transaction, percentage-wise. So they typically have very wide bid-ask spreads. But in a dealer market, where the dealers are competing with each other and they're all posting their bids and asks, then it gets competed down to a very narrow margin. And so the costs of trading, the bid-ask spread is like a cost of trading, even though it's not booked as that. An interdealer broker is a broker that facilitates exchange between dealers. That happens. So a broker-dealer is usually a firm doing business. A person can never be both a broker and a dealer on the same transaction. You have to choose one or the other. You can't both make a commission and a markup on the same trade. Now here's an interesting question. When you buy or sell a house, you will probably deal with a real estate broker, also called real estate agent, and also, well, there's a trademark, realtor. The realtor is a trademark of the National Association of Realtors in the United States. But these are all brokers. What about dealers? If stocks are traded both by brokers and dealers, why not real estate? So, when you sell your house, I shouldn't say that there are no dealers, but you don't hear about them very much. When you sell your house, do you find that a dealer comes to you and buys it and hopes then to market it and sell it? I've been asking people why we have so few dealers. One answer has something to do with taxes, that the dealers would have to pay ordinary income on capital gains. So it just doesn't work out as well. But we do have Immobilienmakler in Germany. So it's, as far as I know, the dealer market is alive and well in Germany. And I still haven't completely figured out, but it's still a minority, I think, of sales that go through Immobilienmakler. So what is good and bad broker behavior? One problem, here's some example of bad behavior. Churning, all right? Now, a broker charges a commission, remember. So every time they make a sale, they charge a commission. So brokers, with the advent of the telephone, have developed a habit of calling people up regularly and saying, I have this hot new investment prospect. And they'll encourage you to sell what you just bought last week, maybe not that quickly, and buy something else. And then you get another phone call in another week. And the broker is such a friendly guy. He's on the, you can call him up call me anytime. He's bubbling with ideas. But every idea involves a trade. So he doesn't care about you. He's only trying to make commissions for himself or herself. So they decided, the SEC decided that this is a crime, that you could get barred from securities trading for the rest of your life, as happened to Robert Magnum in 1999. He had clients with an annual turnover rate of 11. That means they were trading about once a month. Their whole portfolio. And they pointed out that the transactions costs were so heavy that they would have to earn 50% on their investments in order to pay the transactions costs. So, anyone who has any serious knowledge of finance knows that you can't be trading all the time, especially with a broker that's charging a high. He wasn't a discount broker, so he wasn't charging low commissions. So you don't want. So churning is bad.
So let's recap what churning means. Say you have given your broker discretionary authority over your trading account. If your broker is unethical, he or she may engage in churning by executing excessive trades simply to generate commissions for him or herself, although this is not always easy to detect. Churning is an illegal and unethical practice that violates SEC rules and securities laws. One way to avoid this risk is to always maintain full control over your own trading account.
It's one of those tricks that anyone in the industry knows it when they see it. That's why it's enough. Magnum could have argued, I'm sure he did, oh, all these were good trades. I have so many good ideas. They just turned out badly in history. But they should have really were. I was sincere. I wanted them to make money. But maybe he was sincere. I don't know. But probably everyone in the business knows that that kind of broker behavior is bad. So in the United States, the first stock exchange was the New York Stock Exchange, NYSE, which was created in 1792. Not the first stock exchange in the world. The first stock exchange may have been in Antwerp, or I would say Amsterdam, but New York Stock Exchange was the beginning in the United States. And there's a tendency for people to revere the first mover. So New York Stock Exchange has some sort of prestige. That's the first market, traditionally. In 1971, the NASDAQ market was created. It was a computerized market. Believe it or not, in 1971, it was at least partly computerized. We had computers back then, but they created a market. So National Association of Securities Dealers Automated Quotation System, replacing the pink sheets. So here's what used to be. The New York Stock Exchange was the prestige place. Now I should have added, exchanges have listing requirements, so that the firms that are traded on the New York Stock Exchange have to have been around for a certain amount of time. They've had to have some earnings. They can't be fly-by-night organization. The New York Stock Exchange didn't investigate their complete investment potential, but basics, which would require listing. But lots of firms didn't get on the New York Stock Exchange. So the National Association of Securities Dealers was an organization of dealers in these typically small stocks that were not so reputable. They were the disreputable stock market. And they had what they called pink sheets. This was before the internet. The pink sheets were on pink paper, I guess, and they would mail them to you, and it would list bid and ask quotes on unlisted corporations. The third market is NASDAQ small cap. Even NASDAQ made distinction. So these were the low market capitalization stocks. They're really the guy next door type stock. And then the fourth market, large institutions sometimes trade amongst themselves stocks or other assets without the use of any exchange. You don't have to go through an exchange. So exchanges provide standards and codes of ethics. So there's a certain amount of prestige associated with the New York Stock Exchange, but it's fading. As I said before, NASDAQ has often been where all the action is. It's those adventuresome corporations that don't look obviously good to the people who give listings on the New York Stock Exchange. So there's also something called the National Best Offer, Best Bid, Best Offer intermarket trading system, which was created by an act of Congress. There are regional exchanges, and stocks can get delisted if they do something wrong that no longer warrants the confidence of the exchange. Stock exchanges didn't flourish until the late 19th century or sometime in the 19th century when information technology. We were entering the information age by the mid-19th century with the invention of cheap paper, the paper machine, pulp paper, typewriters, carbon paper, filing cabinets. All these things were information technology that made more things possible. Now there used to be other exchanges besides exchanges to buy and sell shares. They used to have lending exchanges. So it used to be from 1926 to 1933, the stock exchange floor at the New York Stock Exchange, where the trading took place, and again it was all done in person back then, people talking to each other and trading. There was a buy-sell crowd on one part of the floor, and there was a loan crowd on the other part of the floor, where you would borrow stocks. This would be for short selling. You would borrow stocks, and you would pay a loan rate on shares that you borrowed. But after 1929, the public turned against the lending market because they thought that they brought on the stock market crash of 1929, that short sellers were somehow responsible. You can choose which stock exchange to list on. Does it matter? Ning Zhu, who was a student here at Yale School of Management and is now at Shanghai Advanced Institute for Finance, finds that, did a study, and they find that Chinese investors tend to trade in stocks that are locally listed. And the stocks that share a lister, share a stock exchange, tend to move together. The people tend to invest in local stocks not because they have an information advantage. You might imagine that people who live in Connecticut, let's say, know what's going on in Connecticut and can predict. That might be true for bankers who are serious about it, but it's not true for ordinary investors. It's a familiarity bias. So if you live in Shanghai, you want to buy stocks from a company headquartered in Shanghai just because you hear about them and you see them and you meet people. It's like family, I guess. You feel better about it. That's not just in China. This is an old screenshot from an electronic communications network called Island that shows a bid and ask for not just dealers, but for everyone who trades on the exchange. The Securities and Exchange Commission wanted to encourage innovation. And so this is like from 20 years ago, I think. And they wanted to see electronic trading going, so they allowed ECNs to be kept as a separate category. So this is one example. It was exciting because you could get on to buy and sell stocks, and you could actually see the book. So now here, you don't have to be a dealer. You can place a bid that I'd like to buy shares, so many shares at such and such a price, or you can put in an ask. Did I say bid is when I want to buy, ask is when I want to sell. So these, you can see the number of shares is small in each case. These are ordinary investors. I mean, there might be some professional dealers trading in it, but mostly it was a kind of an amateur market. So you could buy 100 shares at $35, I can't quite read that, and 62.5 cents per share. And then someone else is offering, does that say 2 shares? The biggest one on here is 500 shares. So these are not big-time trades. So what happens if you wanted to get on to Island, you would open up an account, and then you could place a bid and ask. You could do it on your own, but you have to fill in one of these blanks. So you would get on the computer, and you'd see this thing, and then you type, I want to buy 20 shares at, but now I've got to beat these other prices. You notice that they're decreasing as you go down. The computer has automatically sorted them. So if I want immediate execution, I better put something, I'll say $35.63. So I type that in, it goes on. And then for a split second, you'll see, hey, there's my buy order. And then bang, it's gone. It lasted only like 1 second because there was somebody else with his finger on the sell order. He hit, I'll take it. If you put your order right here at the top, but here's sell a share. If you want to sell, you see that the price goes up. So if you stay near the top, you'll probably get executed immediately. So then it becomes a fun game to play. Then you think, well, you know, that went awfully fast. Maybe I should put it down here somewhere so it's not. Then I won't get executed until someone wants to make a big trade, like say wants to buy 1,000 shares. And if you watch this thing on the screen, it would be constantly disappearing and appearing, the buys and sells. But the same thing is what you saw on Island is the same thing that you see on NASDAQ. The NASDAQ now offers different levels, but this is a screenshot from what dealers see. It's the same game they're playing on NASDAQ. The only problem is that NASDAQ makes it expensive for you to subscribe to their service because they want it to be for professional dealers. And so, but it's the same. Do you see what this is? These are the bids, and these are the asks. It would be the same thing, but you notice that the number of shares is larger. And this is the name of the brokerage company that's, the dealer company that's offering, like Arca X. This is the game that dealers play. So the inside spread is the spread between the bid and the ask. This is slated to disappear in a millionth of a second. High frequency trading is something that has been gradually coming on because of computers. So instead of sitting there with your finger to push the button when the bid ask, when a bid or ask comes up that you want, you can program a computer to do that. And the computer program can trade algorithmically. So that the execution, some of those things you may never even see them. an offer to buy or sell would appear and disappear within such a tiny fraction of a second that you couldn't even see it. So what you can also do is trade. You can also enter on your computer a trade that flashes up for just a millisecond. And so only computers will respond. So that could be a strategy that you would use. You only want to trade with computers. Well, there's no formal way to do that, but you just cancel your order after a millisecond. And that you can be sure that no humans will be able to trade that. So speed of transmission matters in this market. So you have to start thinking about the speed of light. Electricity flows at approximately the speed of light, and fiber optic cables also at the speed of light. So if you are on the west coast of the United States, that's 3,000 miles from New York, and you're dealing with a New York exchange. 3,000 miles at the speed of light, a 50th of a second or 20 milliseconds. That's not going to go. You can't let it take 20 milliseconds. So they have to move close to the exchange. Some people are alarmed by high-frequency trading. They think all these high-frequency traders they can play much faster than I am, and I'm going to be destined to be a loser. But I don't think it's that worrisome if you don't trade too much. They can somehow tax trades a little bit, in effect.
Could you go over the pros and cons of high-frequency trading and possibly whether or not you think this battle to have the fastest connection between cities is adding value to the market?
Yeah, I don't think that high-frequency trading is particularly adding value to the market. And in fact, it's siphoning money out. And recent estimates show that it's a substantial suck on money from, it's not really socially viable. So one recent proposal was that we should change the way orders are executed. Instead of executing them instantly as they're placed, to group them up. Instead of every millisecond trade being executed as soon as it's received, you have them wait maybe a full second, okay, or maybe even 10 seconds. And so it's like having separate auctions every 10 seconds. And all the trades that come in that 10-second interval are grouped together and are executed to the best buyer or seller for that longer interval. And we could eliminate millisecond trading. This has been proposed. It's not my idea. And it sounds like it's something that may actually happen in the not-too-distant future, because there's just nothing gained by... People are installing fiber optic cable so that they can be a millisecond ahead of someone else. In other words, there's already a fiber optic cable leading between two cities, but somebody says, yeah, but it's not the straightest route, and if I cut it off a little bit straighter, I can get a whole millisecond. That's a gold mine to me. Well, it's not contributing to society, but that's the kind of thing that could be changed by changing trading rules.
Do you think there's any incentive by the public to actually push for a regulation that would...
I think so. I think millisecond trading doesn't have any particular advantage. So I think the history of Western civilization is that we do these sorts of things. We're capable of making changes in rules. Now, there's going to be someone who really opposes it, someone who just installed a fiber optic cable that's straighter than the other one.
Does it have to be done by the government for adding some?
Oh, it doesn't have to be done by the government. It can be done by the exchanges. The exchanges make their own rules. The members vote. So if you were a member, most members on the exchange don't benefit from millisecond trading, and they could vote to change the rules.
Do you think high-frequency trading contributes to efficient markets or has nothing to do with efficient markets?
Well, it makes them millisecond efficient. Okay. but only computers can see it. Yeah, I don't consider this one of the top issues facing the world today, because it's only measured in billions of dollars per year that's sucked off of investors by millisecond traders. It doesn't compare with other issues facing the world today. So one thing I wanted to talk about concerning exchanges is a peculiar practice called payment for order flow. So here's what happens. When you decide that you want to buy and sell stocks, you get a brokerage account. So it could be with an individual broker who works for a local brokerage firm that deals with you, the public, some guy you can call up and talk to. Or it could be a discount brokerage firm where you're working online. But when you place an order, you tell your broker, I want to buy or sell shares. How does he or she make that happen? Well, normally your broker could transfer the order to a stock exchange. Then that person at that group could execute the order. In other words, find a counterparty who, if you want to buy, who will sell. But often they don't just hand it to someone. There's someone who will pay them to get your order. And of course, who is ultimately suffering from that? It's you, because that payment costs money. And so people thought that was suspicious. Why doesn't the broker give my order? Isn't it his or her obligation to give my order to the best executor? Maybe I'm not getting the best price. And so in the year 2000, the Securities and Exchange Commission investigated this practice of payment for order flow and wrote up a big report, which you can find on the web. They were thinking of outlawing it. It sounds like it's something that should be outlawed, right? When I go to my broker, why would my broker be collecting money by sending my order to someone who might do a bad job of getting me a good price? But the SEC decided not to outlaw it, and practice continues till today. Controversial still. So the reason they didn't is complicated. You know, these people are all playing games, one sort or another, and it would just change the nature of the game, and it's puzzling to figure out what will happen. One thing is that they often send your order to a millisecond trader, someone who does really rapid trades and wants to see the order first. Okay, it goes to this guy first, and that can have an advantage. But the SEC decided one thing is they were thinking, I believe, that if you outlawed payment for order flow, it might contribute to monopoly power on exchanges, and they wanted to see competition among exchanges. Or they thought it might affect the kind of bids and asks that dealers are posting. When they know that there's payment of order flow and it's affecting millisecond trading, they might post less narrow bid-ask spreads. So they decided it was just too complex to figure out the consequences of outlawing it. And so they decided that payment for order flow has to be disclosed. So your broker has to put somewhere on the brokerage, the BD website, that they're doing this. And they must report statistics on what they're paying and on the order execution quality. This is something that most people don't think about, but do they really get you the best price? You see, a broker has to do a lot of things. Someone who's trading on the exchange on your behalf has to do a lot of things. For example, if it's a big order, they should break it up into little orders, right? And not affect the price by dumping it all on at once. Or they might want to deal with upstairs traders at the exchange. The so-called upstairs traders are not on the floor, but they're big deal. They make big deals and negotiate. So it's a difficult thing to regulate. And anyway, it still exists. We have payment for order flow, despite controversy. I think I've mentioned before, but let me say, there are different kinds of orders. most people place, especially retail clients, place market orders. So you just call your broker, or you go to your online brokerage and say, I want to buy 100 shares. That's it. That's all you say. Then they go in and they fill that at, we hope, the best possible price. The nice thing about a market order is you know that it will be completed. But you can also place a limit order to buy or sell. The limit order is an offer. Let's say it's a buy. I want to buy the stock, but the price has to be below some number, which I'll give. Or I want to sell the stock, and the price has to be above some number, which I'll give. So why would I do that? Well, I'm worried that the price might rapidly change on the market. I can see what it is now by looking on online sources, but I don't know that it will be that when I actually execute. Sometimes the market has a big glitch, or you might come in at a time when somebody else is selling a lot, and in order to get a price for you right now, it might be a really low price. So we had something called the flash crash a few years ago when the stock market in the United States dropped tremendously in a matter of minutes. And a lot of people who placed market orders said, I'll never do that again. It'll only be limit orders. A stop-loss order is the same thing as a limit order, except it involves you naming a price as well as offering to buy or sell. But it's different. With a limit order, you say, I want to sell at any price at or above the price given. But with a stop-loss order, it's I will sell at any price at or below the price I quote. So why do I do that? Well, I quote a price, let me see, what is it? I'm talking about buy or sell. Usually a stop-loss order, I think, is an order to sell. And you want to say, I want the broker to sell if the stock price falls below a certain amount. Presumably I own the stock. I don't want to lose too much. It's like having a put option that we talked about before. I want it to get out if the price falls below a certain point. So I wanted we're now getting into other aspects of finance. And so this is a lecture on public finance, which means finance of the government. Now you might think that the government is separate from finance, but it's not. The government is just another organization that confronts markets and lenders like other, and it always has, going back into long history. So I'm going to talk first about government debt and default, which is failure to pay. People, when you say the government might default on its debt, the first reaction that many people get is, oh, that means you'll lose everything if you invested in it. That's not what it means. Default is not the same thing as repudiation. Repudiation of a debt occurs when the government announces, we're never going to pay, forget it, gone. Like the communist governments in Russia and China repudiated their government debt. There's also a concept called odious debt that's been often. If a new government comes in, they can sometimes say, the past government was so corrupt and stealing, this is not the debt of our people. It's the debt of some criminal that we finally got rid of. So that's odious debt. It stinks. We will not pay it back, and we're morally right not to pay back what this person took from all of us. So this happens, but usually not. Even after a revolution, they usually don't completely repudiate the debt. So the question is, if governments default with some regularity, why do you invest in it? Well, that's a very basic question which you should understand. You invest in it because it pays high interest rates. Governments that are in danger of default have to pay higher borrowing rates, or the price is at such a discount, like we mentioned, 20% of the principal for the Venetian debt. It gets that it's actually a good investment, even though you're perfectly aware that they're going to partly default. The reason they don't repudiate typically is because you can only do that once, and no one's going to lend to you again. You might need to borrow again. It's also just damaging for a country's reputation, unless you have some real ideology that justifies calling the previous debt odious. So the communists, I guess, got away with it, although nobody would lend to them again. They weren't borrowing money. And you could say that it was a big mistake because in China, for example, they had famines under the strict Maoist government, and they should have borrowed money and kept the people alive, but they didn't do that. So Carmen Reinhardt, in her editorial, is worried that we could be in for another debt crisis in multiple countries. She particularly outlines Ukraine and Puerto Rico as Puerto Rico is a dependent on the United States, but it has its own debt and its economy is not doing well. They issued all this debt, and they think that in Puerto Rico maybe they have a justification for defaulting and they won't lose their reputation. It's the kind of thing that happens, you know, the Puerto Rican economy needs some kind of boost. Ukraine is another example. But the biggest example is Greece, and we must be heard about that. Ever since the sovereign debt crisis in 2010, this crisis in Greece has been smoldering. In 2015, Greece actually defaulted on some of its debt, but it's not over yet. It just drags on for years and years. They've been actually paying their interest until 2015. Now it's getting a little shaky. Again, it's when a country can't pay its interest on the debt, then what happens is there's a negotiation. They come to an agreement called a restructuring, which allows them to pay less. Typically, the owner of the debt will expect some loss given the reality of the situation, but try to make an agreement that will preserve some of the value. So that's what's happened in Greece, but it just tends to drag on.
You mentioned that if a corporation default on its bond, then the creditors can take over the company. But I'm just wondering, what if a government default on its bond? Who should get paid first, or how should the government deal with it?
Great question. The problem involving governments, national governments, is that there is no court of law, no international court of law that will handle that case. So it becomes difficult. You're dealing with a government which has it's the ultimate power regarding these payments. So what you do is you call them up and you say, we're really mad, you're not paying us. Well, they can say, forget it, you know, they can hang up on you and that's it, it's over. But then you have to rely on the government's self-interest. You know, the dictator of some little country hangs up and says, we're not paying. Then he tells his advisor, and he said, you said that to these foreign investors? Do you realize they're never going to invest in us again, right? You can't. So now he starts to have doubt that I shouldn't have just hung up on them. So he has someone put a call in back, and they say, okay, we're not going to just not pay anything. Let's talk, right? Isn't that what, if you were a dictator, you would probably come around to doing that, right? You don't just hang up on them. So there's a meeting of all the different creditors. Well, you have trouble because you've sold your debt to many different countries. And they don't all even show up at the meeting. And so then you make an appearance. Now you realize you can't destroy your country's reputation by just refusing. So you're going to be reasonable. So you get up in front of your investors and you say, look, you know, our economy isn't doing well. We have a revolt brewing in some region. You know, we just, you know, you really can't expect us when we're in such difficulties. And so the investors in their debt on the other side start thinking, well, okay, you know, they're not going to pay us. Let's take the tactic of being reasonable and say, okay, we'll offer to cut your debt by 30%. How about that? Then you start negotiating. You can see how the negotiation, it's not within a rule of law, it's just, it's all in the court of public opinion. Now here's what then happens. So say 70% of the countries agree, of the holders of the government debt agree, but 30% of them don't. And they storm out and they say, I don't like, so they agreed to cut the debt by 50%. Then what happened? Then it just it goes on, because they didn't get agreement on all of the debtors, all of the investors in their debt. Are you following me? And then it just makes things so difficult for a long time. Then, so if you are living in Canada and Argentina defaulted in 2001, and Argentina isn't paying you, you say, hey, I have an idea. I'll go to a Canadian court and I'll ask the Canadian court to take something from the Argentine banks that operate in Canada. And because, hey, I have it in writing, they promised to pay this. And so then it starts harassing the Argentina. So Argentina finds it difficult to do business in Canada because all this mess, they want to clear it up. So there's been a movement in sovereign debt toward adding what they call collective action clauses. So it has the following form. When you buy the debt from, let's say, Argentina, it says, you sign a contract when you buy it, that you will agree to anything that's voted by a supermajority of the other investors in the same bonds. And so if there's a collective action clause, it prevents this hold-up problem. And so increasingly, countries are putting collective action clauses in their debt. But it's not always yet, and it still involves this same kind of messy negotiation. By the way, sovereign defaults are not that rare in history. It's happened many times. So this is life in the debt market. This is from the Reinhard Rogoff. Well, it's from her editorial in December, but it's ultimately from her book with Rogoff. This is, for the world, since 1800, the percentage of countries in the world who were at that time, in external, that means default to foreigners outside the country, external default or restructuring. So it seems to range, there are some good years, not so many of them. Right there, that looks like it's about 1818. Okay, that's right after the Napoleonic Wars. I'm surprised. Well, maybe they'd already restructured their debts and they didn't have any, so there wasn't any more restructuring or default for any country in the world. But that's the only time when there wasn't one. And it's been up to like almost half of the countries. You can see there are waves of defaults. Now this ends with the publication of their book. There wasn't actually much default right after the financial crisis. But she's suggesting that there might be another. They've seen these periods of default around the world happen repeatedly. And it would be not surprising if we saw another one soon. I don't know about right away. These things seem to take, it looks almost like a cycle, doesn't it? But the cycle is decades long. And I'm not saying it's a cycle, but it shouldn't be a surprise if we see more default on debts. Okay, next thing is government involvement in the corporate sector. Okay, so capitalism is supposed to separate the government. The government does not get involved in business. So you might imagine that the United States, which is the most capitalist country by reputation in the world, would not have any government involvement in business. But actually you would be wrong. First of all, the government regulates business. And secondly, the government can own shares in business. The United States government is the least likely to own shares in business. Other countries like China have the government with major shares in their business. That's a difference. But even so, non-government business know that they may be nationalized in the future. There's always a threat. So there's an implicit claim, even in the United States, on businesses that might be nationalized. But as you know, there was a tsunami that overwhelmed the east coast of Japan, and the electric power company on the coast in Fukushima was overwhelmed by the tidal wave, and it spilled radioactive materials and cost immense dollars to the Japanese economy. So here, this company had done tremendous damage through not having proper preparation for this kind of event, which seismologists could have told you was a possibility. They took risks. They were betting that it won't happen. Well, it was an unlikely event, I guess. But ex post, who bears the cost now? Well, it turns out it's the Japanese government because of limited liability. They can't impose all the costs of the nuclear disaster on TEPCO. Well, it would just drive them out of business. They can't do it. And since we can't go, Japanese government can't go after the shareholders, which include your parents, I think, maybe you. Effectively, you don't know it, but many of you are shareholders in TEPCO because your parents have a bequest for you planned, and the bequest will include some international equity fund which owns some. So your parents don't even know that. You can ask them, do you own shares in TEPCO? And they will never have heard about it, but they do own shares in TEPCO. So could the Japanese government go after your parent, or let's make it even more personal, go after you for owning shares in this company that imposed this huge disaster on Japan? Well, it's just unrealistic. You can't do that. It's not the law. So they had to deal with TEPCO, and the Japanese government had to decide on what to do. Should we drive them to zero? And, well, it ends up that the government owned, as of July 2012, 50% of the new TEPCO, and it has preferred shares. It has debt that it can convert to preferred shares. So the Japanese government owned the 88.69% of the company. So your ownership share, which you don't know you have, but you do have likely an ownership share, has gone down to a low level. The other thing that's happened is the share price dropped. So this is a plot of TEPCO share price from 2003 to the present, okay? And can anyone guess when the earthquake hit? By looking at this chart. So the other thing that governments do that make the government a shareholder in business is bankruptcy. So if you are a company that can't pay its debts, all right, because you're in trouble, the business isn't doing well, you've just had an earthquake or something, and you can't pay that back. What you are invited to do by bankruptcy law is to file for bankruptcy. Now you do this because you're in trouble and you can't pay the debt. So legally, in order to avoid a prison sentence or something really bad, your lawyers tell you, take your pick. Do you want, well, you might not be able to take your pick. The bankruptcy court may not allow you. But Chapter 7 is for companies that are so bad off that it's best just to shut them down and sell everything else. And then they're done. And if there's anything left over after you've paid off all of your debts, the shareholders in the company can get a liquidation amount. But typically there's not even anything left over, so the shareholders are wiped out. The debt holders get pennies on the dollar. All the assets are sold and they end the company. But Chapter 11 bankruptcy is used for companies that still have some enterprise value that you can argue shouldn't be shut down because we're doing something that people value. So let's reorganize the company. So you might wipe out the shareholders, or you might maybe keep them alive with hoping that they'll get reimbursed. So General Motors is an example of that. But you see what's happening is that the government is accepting some of the losses of the company in trying to deal with the bankruptcy. Personal bankruptcy is similar to a corporate bankruptcy because it allows you to take risks and have your negative consequences borne by the government, as long as you're not criminal. Of course, even if it is criminal, all they can do is put you in jail, and they still end up taking the loss. So the government is like a shareholder, inevitably, even when it tries not to be. So I think it was an apt title. David Moss, who we mentioned before, wrote a book called Government as Risk Manager of Last Resort. Now I want to go to municipal finance. That is, now incidentally, we have to distinguish between, in the United States, between state governments and local governments like cities. Because state governments are sovereign. They are like separate countries. Remember, the United States began like the European Union. There were 13 colonies. They were separate countries. And they came together and formed a union. But they're still separate countries in the law. So the federal government is not going to make laws about bankruptcy of state governments. But they do make laws about bankruptcies of municipal governments, cities. So the basic motivation, now cities borrow money. Why do they do that? It's the most elementary thought that I want to get clear. I would say, you could say city government shouldn't borrow money. They can raise taxes and they should pay, they shouldn't go into debt. Why does a city go into debt? You might say. People do say that. Why don't you just finance everything by taxes? But there's a really important reason why they don't finance purely by taxes. And that is, there's a problem of population inflow and outflow. Suppose you are a young city, newly established, and you have a reasonable prospect of expecting to grow. So there will be a huge population in the future. It would be reasonable, wouldn't it, for the government of this new town to set out roads and sewers and other basic infrastructure, do it all at once, do it right. Bring in a consulting firm, expensive consulting firm, lay out a grid of streets, and then put the whole sewer system in now. I mean, rather than do it piecemeal, it's more efficient to do it. But how are you going to pay for it now? Because the people who are there, and there aren't many people who've come yet, you'd have to put enormous taxes on them. That obviously is unrealistic. So the city government will borrow money to put into these infrastructure investments. And then they have the right to tax future people who come in to pay off the debt. So they're making a gamble that people will come in. It may be a very reasonable gamble, but they have to convince the lenders, the borrowers of the municipal, the buyers of the municipal bonds, that it's a reasonable prospect that you will get repaid. So you have to agree, isn't it obvious? Or schools, right? You have to, you know that people are coming into your city. Let's get a lead on it. Let's not have them come in and then there won't be any classrooms. Let's have an extra amount of classrooms now. You want to finance that by debt. But now, have you heard this, that in the United States, almost all state governments have prohibitions against deficit spending, against the state governments borrowing money and spending it instead of raising taxes. Let me give you an example. I'll just pick our own state as an example. The state of Connecticut initiated an income tax. It now stands at, I think it's 6.7 or is it 6.8? Somewhere in that, I should know, I pay it, but it's only 0.1%, I might be off. So they, and I'm talking about the top bracket. So they, Governor Lowell Weicker was an independent. He campaigned, he put his personal reputation on the line, saying Connecticut, which is then short of money, needs an income tax because the income tax is a fairer way to raise money. It taxes people with more income, rather than sales taxes, which tax everyone the same. So it's progressive. It's hard to sell that, though, because your influential people tend to have higher incomes. So how did Lowell Weicker do that? Well, he's very proud of it, that he did that. It was the right thing to do. they had to have a constitutional amendment to get it by. And then he was not reelected. He's out for This is an example of a profile in courage where he did the right thing, and it got him into personal trouble. But in order to get it passed, the Connecticut voters wanted something in exchange, so they put in a balanced budget amendment for the state of Connecticut that it cannot do deficit spending. And so, but then if you look, no, wait a minute, you say there's Connecticut government bonds. How can it be? If we're not allowed to do deficit spending, why do we have debt? Then you have to understand the way it works. The prohibition against deficit spending is on the current account. The government, state and local governments have both a current account and a capital account. And on the current account, it's their expenditure, inflows and outflows for current things like salaries, taxes come in, salaries go out. That's the current account. But if we borrow money to build a school, that doesn't even go onto our current account because that's capital. We're not it's nothing irresponsible. Building a school, is that irresponsible? So we are allowed to do that. So states can borrow if they can justify it as for making a capital expenditure. There's also state and local governments issue bonds that look a lot like GDP-linked debt in a sense. It's not GDP, but they're linked. They're more like equity. They're called revenue bonds. So if a city issues debt for a particular project, like building a toll road, or a toll bridge, which has money coming in to the state from something other than taxes, then they can issue bonds which promise to repay the debt out of the toll revenue in this case. So it's like a business that the government is engaging in. It could be a private business. We could have a private company building a bridge. This used to happen. I don't know. It's not very common anymore. But a private company could build a bridge and plan to make money by charging tolls on people who cross the bridge. But typically that kind of thing is done by state and local government. And it does it with revenue bonds. So revenue bonds are like equity in a government project. So it's good to know about revenue bonds if you are a public-spirited person and you want to see something happening that looks like it's a business prospect, but it isn't happening for maybe some subtle reasons in the private sector. You give up your idea of starting a new company. You might think, I want to form a bridge company. We need another bridge over the Quinnipiac River here. You could start a company and build a bridge, but you might have problems, maybe legal problems in enforcing toll, I'm not sure. But anyway, you decide it's not going to work for me, but it's still a good idea. So what do? You go to the mayor or the governor of the state and you say, I have an idea that can be financed by revenue bonds. Now, governors like this better. When you come and say, it's an idea for something you can do, and you don't have to raise taxes. You can issue revenue bonds. It sounds more saleable. So remember revenue bonds. That's an alternative to your budding dreams of becoming an entrepreneur. You can participate in local government in an entrepreneurial-like activity. There's nothing new here about this. There's a special bankruptcy law. I mentioned Chapter 7 and Chapter 11. Chapter 9 is a special bankruptcy law for municipals in the United States Code. Also, this slide, the title might be inappropriate. There's a lot of talk about balanced budget amendments, and it continues today, not just in the U.S. but in other countries. But I think it's maybe, I don't support a balanced budget amendment because I think we need deficit spending as an economic stimulus. But it's not as bad as it might seem if you reflect that these Schuldenbremse, for example, doesn't, I think, it doesn't prohibit local governments from doing deficit spending for capital account. So Government social insurance. Well, the government gets involved in insurance. The first major government involvement in insurance, which ought to be a private, you might think ought to be a private business, started out as a private business, occurred in Germany in the 1870s. There was a lot of, Germany was the most advanced country for forward economic thinking at that time. And a lot of Americans went to get their PhDs in Germany. People like Lujo Brentano, Gustav Schmoller, Adolf Wagner said that the government should use insurance principles. Otto von Bismarck was not an economist. He was the head of the German government. What do they call him? Kanzler. He wasn't really very involved in this, but his government did this. It created Krankenversicherung, and that's sickness insurance, in 1883. Unfallversicherung, accident insurance, 1884. Und Invaliden- und Altersversicherung, old age insurance, in 1889. In his memoirs, Otto von Bismarck wrote his autobiography. He forgot all about this and doesn't mention it. I don't think it came from him. It came from these economists. It wasn't until the Germans did not invent unemployment insurance. It was in the United Kingdom with the impetus of Lloyd George in 1911. Now, these are all insurance things that you might think could be handled privately. We do have examples of private sickness insurance, accident insurance, and old age insurance. We've got them all. So, and not unemployment insurance, except maybe there is some example, a minor example of unemployment insurance. I know it's been proposed. I think it might happen soon, by the way. People call me up with their ideas. Maybe in the next 5 years there will be privately offered add-on to government unemployment insurance. That's a major force. So why does the government get involved with these things? Well, I think it has to do with the private sector can manage certain things well, but not everything. And it's hard to sell some of these to the public. They're mistrustful. Do I have a slide? Yeah. This is Gustav Schmoller. And around the early beginning of the 20th century, he wrote his memoirs. And he wrote that it was the triumph of insurance in every imaginable area was one of the century. He's talking about the 19th century. Great advances. It was an entirely logical development, replacing the older charitable relief funds. It used to be religion which dominated our lives more. And religion did provide insurance. Maybe I should have mentioned that. The church provided insurance. The earliest insurance contracts seem to be religious documents. There's other kinds of insurance. Aid to families with dependent children, created in 1935, was to support people who couldn't feed their children. It was abolished in 1996 in reaction to what was perceived under President Clinton as an accelerating moral hazard problem. People thought that we're developing a class of people who've lived all their lives with AFDC and have no plans ever to work, and that struck them as wrong. So we have modified that, although still we are still feeding. They changed the food stamp program's name to SNAP to disguise it, Supplemental Nutrition Assistance Program. But we still have them. We still have something analogous to AFDC. So there's so many other things. Progressive taxes are a risk management device because if your income falls very low, your taxes go down. And in fact, we have negative taxes for very low incomes in the US and other countries because of the Earned Income Tax Credit and its analogs. We have free public education. That's an incredible transfer to the unsuccessful people who unsuccessful in terms of earning income, so that their children will still be supported with decent public education. Social Security, OASD stands for Old Age Survivors and Disability Insurance. And we have government health insurance, notably Obamacare, which I didn't put on the slide yet. Workers' compensation was a movement before the federal government began really providing much insurance. workers' compensation was a movement that went across the U.S. states, and now I think every state has it. And it spread across the whole world. I could give a whole lecture on this. It's an interesting story. To protect people against job-related hazards. The theory was developed by economists, I think in Germany first, but spread to the United States. The idea, that's Arbeitsversicherung. It is Germany. So what is Arbeitsversicherung? It's insurance that the employer must buy for the employees of the company against accidents at the workplace. And since they're forced to buy it, it helps employers improve the safety in the workplace. It provides an incentive. That was the argument. It internalizes the costs. It used to be, when Lloyd George went to Germany for a visit in the 1890s or early 20th, one thing struck him. There are no cripples begging on the streets. He said, why not? In London, they're all over the place. Well, this is what you had to do. You would be injured at work, and you'd lose your legs, and now what do? Well, first thing you do is you try to sue the employer for having an unsafe workplace. You could do that, but it's very hard to win a suit like that, because how do you prove that it was the employer who did it and not your own negligence? They could call the other employees to testify, but they're not going to testify against their own employer. So you couldn't get it. You ended up on the street begging. So Lloyd George said, we have to do this too. And it spread all over the world. And we still have it. I once, on an airplane, I sat down next to someone. I occasionally converse with people next to me on airplanes. And she worked for the state of Connecticut workers' compensation law. And I said, well, that's fascinating. Tell me about it. And she said, you're the first person to say that's fascinating. It's not glamorous. It's not talked about. It's just there in the background. You don't even know you have it. But when you take a job, you've got this insurance policy. In the United States, we tried to create an income tax during the Civil War between the states. And it was a low tax rate. But the problem was that they couldn't measure people's income. Only 10% of eligible taxpayers actually paid, by one estimate. The fraud was too easy back then. One problem was that how do you know what someone's income is? They didn't have documents. Your employer would pay you in cash, and so how does anyone know? And your employer wouldn't keep records deliberately because there's an income tax. So they rescinded the income tax in 1872. We had a much more corrupt government then than we do now. So some economic historians say that economic development tends to have a slow process occurring over decades against corruption. Eventually, if it works out well, advanced countries are much less corrupt than the lower countries. And it's partly because they have regulators and they have law enforcement that creates a standard that eventually is accepted. You don't bribe the police officer, right? If you're pulled over for speeding, does any of you, I can ask you this, do you say, hey, look, I'll give you $100. I don't want a ticket on my record. You might do that in some other country, but it's just not done here. Unless I'm naive, I don't think it's done. I don't think any of you have tried doing that. Also, another important invention in history is the withholding of income taxes. That they don't expect you to pay up at the end of the year, because that would mean that you'd be expecting people to save money to the end of the year to pay their taxes. Well, they're not going to be able to do that. Maybe they can, but what do you do with someone? There's a family that looks like it's starving, and they come into you're not paying your taxes. What are we going to do? Put the father in jail? What's that going to do? So it's better to create a tax system that withholds. It's an invention like any other. I think it's a behavioral finance invention. I mentioned survivor insurance. The amazing thing to me is that when they created it in 1939, that the insurance industry didn't vigorously oppose it because it was competing with what private insurance companies were offering. One thing they did in order to confuse the issue is to rename it survivor's insurance I mean, this is phishing, but it's well-meaning. The government thought, we won't even call it insurance, life insurance. We'll call it survivor's insurance. That sounds completely different, but it isn't. With life insurance, you insure someone against the death of a named party, and then there's a beneficiary named in the contract who gets it, usually the child, or sometimes the wife, or it could be the other way around, it could be the husband. But if you rename it survivor's insurance, insurance companies don't have to mention when they're selling insurance that you already have life insurance. If they called it life insurance, they'd have to mention it. So let me just say that public finance shares many aspects of private finance and insurance, but they are different traditions and they have different vocabulary, a different culture. Once again, progress in innovation is slow. It's always about the same general themes. It's about incentivization of good actions in a risky world. People have fears and purposes, and they like to have some choice of alternative financing methods, but they often miss the choices, so we have to give them something automatically.